This is Chris Casey, Managing Director at WindRock Wealth Management. Today I'm joined by Mark Whitmore, founder and CEO of Whitmore Capital out of Seattle. Whitmore Capital specializes in trading currencies relative to their intrinsic value using a proprietary long-term strategic model. Mark, thank you for joining us.
Hey, a pleasure to be here, Chris.
Now, most investors are focused on stocks and bonds and sometimes real estate, but they forget about other investment asset classes, and one of which you could say is currencies. Why should investors consider currencies as a viable asset class?
Yeah, very good question. I think that there are sort of two ways one can look at that. One is the fact that, unfortunately, whether investors know it or not, they have indeed a currency bias in their portfolio. And if you're dealing with domestic investors, typically there is a home currency bias. So even though on a market cap basis, the United States stock market does not equal half of the world market cap, most U.S. investors will have a majority of their stock holdings, for instance, the United States. So there's a de facto bias that investors will have unless they're very conscious and have decided to allocate their investments accordingly among traditional asset classes. So that's one thing I think it's important for investors to keep in mind, is that they have currency risk even if they're not aware of that currency risk. So from a proactive standpoint, we look at currencies and asset classes being a very important, diversifying, and potentially an element providing solid capital appreciation, as we have looked at previous instances where in particular economic unwindings have occurred, and there are very specific trends that can be identified in which currencies have underperformed or outperformed. And similarly, once crises have passed, there tends to be an environment in which there are a different set of currencies that have tended to outperform or underperform. So we think that there is a good opportunity regardless of the macroeconomic environment with regards to currency investing, whereas certain traditional assets obviously can have a bias towards doing particularly well as long as basically investors are in a risk-taking mood. But once that switches and then economic times can pivot, basically, it's very difficult to be able to have solid returns if you're investing in, for instance, global equities at the time of 2008, 2009.
So let's use as an example that 2008, 2009 time period. How were investment portfolios potentially assisted by some currency investments?
Right. So at that time, and I don't mean to drill down in the weeds too much, but on a very basic level, during times of economic expansion, and particularly blow-off stages of financial bubbles, what you'll see is something called the carry trade that's very popular, namely that global investors who are looking to deploy assets will essentially put a great deal of concentration in certain currencies that have high interest rates. Some of these currencies, in fact, they tend to be currencies in emerging markets in particular compared to developed markets. So going into the 2008-2009 financial crisis, you saw a concentration of assets in those particular currencies, oftentimes borrowing currencies like the Japanese yen, which was essentially a zero interest rate currency then, as it is a zero interest rate currency now. And you saw deep declines in those emerging market currencies, along with currencies like the British pound, for instance, which was highly leveraged to the financial health of the financial markets. People who traveled to Britain at the time may or may not recall that the pound at one point reached $2 to the pound, which was an extremely high level and was deemed by myself at the time to be something that looked quite stretched and overvalued. And sure enough, the pound unwound dramatically in the months and several years into the global financial crisis.
It reminds me that one of the perhaps underreported stories over the last 18 months or so has been the U.S. dollar relative to some of those emerging market currencies, whether we're talking about Argentina, Turkey, etc. What has been the reason for those currencies plummeting so much relative to the dollar?
Yeah, so and those are really the two that have taken the global spotlight in terms of capital losses that were quite large. And what we tend to find is that imbalances, financial imbalances, don't matter in a bull market environment until they do. And both in Argentina and in Turkey, you saw combinations of reckless financial monetary policies coupled with either political upheaval and or uncertainty that caused ultimately investors to say, that seems like it's gone far enough. Now, it is interesting because both currencies have after bottoming out several months ago, have stabilized and begun to show some signs of essentially some near-term capital appreciation. Turkey in particular, I would argue, still looks very vulnerable. The Erdogan regime has attempted to undermine the financial independence of the central bank. Elections are coming up, and I think that there's a fair amount of risk in the lira in particular that could see a second phase, especially if that happens to run concurrent with a general global financial unwinding, which I certainly think could be in the cards in the coming months.
So you mentioned a few things that have hurt certain currencies, in particular these emerging market currencies. Now, before this call, I actually did something that I recommend no one does. I actually Googled what makes a currency worth more or less relative to others. And even if someone didn't have any economics knowledge, you'd see that the arguments you typically see on the internet there are contradictory or kind of silly. I mean, what in your opinion makes a currency, either from a demand or supply aspect, worth more or less relative to others?
So that is like the $5 trillion question. I'll say $5 trillion because that's the amount of currency trading that takes place in any given day. And so you see a marketplace that is essentially the prevailing mentality is one of a very short-term nature. So within currency markets, people will oftentimes look at, for instance, trend following or technical kinds of analysis to try to identify currencies they think are going to be continuing to appreciate or depreciate. Our view is one of a strategic view, so we try to step back and say, okay, what are more fundamental factors? And there are a hodgepodge of them, and kind of the art, I would say, is being able to sort of identify at what point in any typical global financial cycle will some factors be more important than others. And to give you an example, purchase power parity, for instance, is the idea that if I travel to Canada and if I buy a dress shirt, it should cost roughly the same once you translate it into Canadian dollars as it would in the United States. If there's a huge disparity, like there was in 2002, where the purchase power parity in Canada versus the United States was that something would be up to 40% cheaper in Canada, that should represent an unsustainable situation. And ultimately, arbitrage will induce both consumers and ultimately even currency investors to arbitrage away that difference. And sure enough, what you saw was the Canadian dollar significantly gain value from its 2002 lows, and the US dollar go down rather significantly. So that's kind of one anchor measure where you could sort of identify what fundamental factor would affect a currency over time. But then there are also other factors that could have a significant impact, again, especially depending on where you're at in a global economic cycle. Things like budget imbalances, money printing, current account deficits, oftentimes can be glossed over and ignored while investors are broadly in a risk-on appetite mode. But if things change, those things all of a sudden can become extremely important and can cause money to essentially flow out of any particular currency who's seen as being vulnerable. Similarly, interest rates would at least provide a potentially, assuming that you have interest rates that are higher than your other country peers, would provide incentive for investors around the globe to take advantage of a higher carry by utilizing investments in that particular currency. So those are a few of the fundamental elements. We look at about, I think, 9, 10 fundamental factors, and we have sort of a weighting system depending on what environment we're in to try to identify a fair value for a currency.
And when you're looking at different currencies, typically you're operating under a system of floating exchange rates, where the free market, for the most
Exactly.
part, is determining their relative prices, absent central bank meddling. But there are exchange rates that are, whether they're fixed or there's what they call like a dirty float, where they're effectively manipulated.
Yep.
So, for instance, the yuan and the dollar, the Chinese currency versus the dollar, is effectively fixed. How do you see that changing, if at all, and does that represent potentially an opportunity?
Yeah, that's another really good question. I would kind of use two examples as the extremes. So on one hand, you have the Hong Kong dollar, US dollar fixed exchange rate, which has hovered between 7.75 Hong Kong dollars to the US dollar to 7.8 for decades. That has been a remarkably stable fixed exchange rate system. There has been times where it has been under stress, but the Hong Kong Monetary Authority has always been able to essentially keep that band pretty consistent. On the flip side, you saw at the beginning of 2015, the Swiss central bank attempt to essentially fix its rate to the euro. They were concerned that the Swiss franc had become overvalued compared to the rest of the euro, and hence the Swiss franc was non-competitive. So they attempted to essentially sell the Swiss franc on the open market and use their forex reserves to weaken the Swiss franc in the same measure as the euro. Ultimately, in January, they could no longer maintain that, and at one point, the Swiss franc appreciated 40% against the euro virtually overnight. It was a stunning development that has rarely been seen in foreign exchange markets. So what it shows you is that governments can sort of stand against market forces, and if they have deep enough pockets, they can do that for a very long and potentially even indefinite period of time. If, however, market forces overwhelm their resources and essentially call the bluff, and George Soros famously did that with the Bank of England many years ago, that can lead to explosive reversals in currency valuations. And so that's one of the things that we perceive as being one of the opportunities out there in the foreign exchange market, is that governments sort of working against market forces typically will run out of bullets before eventually they have to capitulate and the market takes charge ultimately.
The dollar has traditionally been viewed as kind of a safe haven asset, along with U.S. government bonds. Do you think that's going to continue with the next financial crisis or worldwide recession, or do you see that changing?
This is probably the most hotly debated topic in the currency world right now. For those of us who try to look beyond just what's going to likely happen in the next 6 months in the currency markets, but rather are looking at a year and a half, 2 years, 4 years, 5 years down the road, there are those that argue that the United States dollar is still a de facto reserve currency, and that in particular with regards to international commodity transactions, the vast majority of those take place in US dollars. And this unique position that the dollar has makes it an ultimate safe haven currency, because unless and until you get a repricing in a different currency unit, and there is definitely a trend towards that, I think that's undeniable, but still a majority of the transactions are very much US dollar denominated, that the US dollar will kind of maintain its safe haven status. The counter argument, which I think is also quite persuasive, is essentially you have had the United States engage in fiscal and monetary profligacy at an unprecedented level. And on top of that, you've seen trade deficits, renewed trade deficits as of the last couple of weeks ago, reach levels that they have not hit in years, and a continued deterioration of our fiscal and monetary well-being, and that this at some point will cause the dollar to essentially begin to unwind and do so dramatically. Where I sit in the debate is I see a sort of a three-step likely trajectory on the US dollar, and again, this is me just giving a probabilistic analysis here, which is I think in the near term there's enough pressure on the US dollar based upon its fiscal unwinding and the fact that there's a lot of concern about whether or not we're going to be able to enter into some kind of trade deal with China, which is going to stabilize both economies and the like. And there's enough uncertainty that I think that the near term you likely see weakness in the dollar. In the medium term, I would expect that if indeed financial markets begin to unwind and this extremely long global recovery begins to then enter a period of global recession, that the dollar will likely be seen as a safe haven. Part of it is historically international investors have tended to flock to U.S. Treasuries as a safe haven, along with, say, Swiss franc denominated bonds, possibly Japanese yen denominated bonds as well. But in the longer term, you are going to see the United States dollar continue to decline on a 10 to 15-year basis, I would say, compared to a broad basket of global currencies, and especially emerging market currencies, I would say. But that's probably on the other side of a global economic downturn.
And how do you see such a downturn or financial crisis occurring? Meaning, how do you see the Federal Reserve or the International Monetary Fund getting involved? What will be their actions? What will come of, special drawing rights, SDRs? Will they come into play, and what will the effect be?
So I think one of the things that has been a hallmark of the of global monetary policy since around 2000 is an increasing level of synchronization and coordination. So I think it's unlikely that you're going to see the United States and the Fed do anything that's going to deviate from what is likely going to take place in other major central banks. As a result, I think just like occurred in 08 and 09, where you largely saw coordinated central bank intervention and quantitative easing, I fully expect that that will be the playbook that you will see deployed in this instance as well. I suspect that the International Monetary Fund will actually not be in a very strong position to do anything unilaterally. And with regards to special drawing rights, for instance, I think that as long as you're in a period of economic uncertainty, you will likely see kind of animal instincts or animal spirits kind of gravitate towards the traditional safe haven plays. And there is going to be any appetite for a new and innovative solution coming from the International Monetary Fund, for instance. So I would expect that you would see eventually disillusionment amongst global financial actors. We have seen QE1, QE2, QE3. At some point, it should become evident that while the Fed can try everything it can to liquefy the financial system, ultimately, if we collectively have decided that we would rather hold safe, even if they're investments which would lose money because they're earning almost nothing in terms of interest and there is an inflationary backdrop of any kind, that would be preferable than exposing themselves to risk. So it's the classic, the Fed and central banks would be pushing on a string. At some point, up to this point, I should note that financial markets have essentially bought into the idea that the Fed and other central banks can collectively bail us out. My concern is that at the next financial crisis, that confidence game may eventually unwind, and that investors at that point may finally determine that the Fed and other central banks can't just print a bunch of money and encourage us to borrow more to get us in the very same position, namely to be over leveraged like we are now. That was the problem in 07, for instance. So it's going to be interesting to see whether or not there's ultimately a more sustained bear market than we've seen in the previous two bubbles that have burst.
And what about the euro? Do you count that as part of the so-called safe havens along with the dollar and I assume the yen, or do you see that as potentially the weakest of the major trading bloc currencies?
Yeah, great question. Of the big three, I do see it as the weakest in terms of how it would perform as a safe haven currency. And I think that the primary reason for that is because of the perceived and quite frankly objective weakness of Italian banks, the overall strength or weakness of the Mediterranean economies. And I think that that's going to be something which is going to be seen as a deep vulnerability. I think the euro experiment is one that is fascinating and in the best interest of all participants, but it has put individual countries in very disparate economic situations at odds with one another. It's just very difficult for a Germany and a Spain or an Italy to be pursuing essentially the same monetary policy despite having radically different structural problems with regards to their economy. So that's where I do see the euro as being likely the weakest of the three. Interestingly, I would say that if you add the big four to include Great Britain, I think Great Britain stands to lose the most, again, this time going into any kind of general global financial crisis. There's been a lot of attention obviously focused on Brexit. And in some ways, I think that's actually covered up a lot of the deeper structural problems with the economies, and London is still heavily leveraged to financial markets. And one of the interesting things to note is that a number of financial institutions have moved operations from London to the continent, and I saw one particular interview with somebody who was talking anonymously from one of the big three global financial powers, and they were basically saying, regardless of what happens with Brexit, they're still going to continue to move towards the continent, and largely it's just been because of the amount of cost that they've already endured to make that happen. So there's, I think, a false perception that if they can somehow avoid a hard Brexit, that everything's going to go, quote, back to normal. And I just perceive that that's unlikely going to be the case.
And for our last question, as far as actual items, do you have any thoughts on some currencies that you think right now, based on your model, look undervalued or overvalued?
Yeah, absolutely. I need to preface this by noting that I don't want to give any specific investment advice here, and especially since currencies can utilize leverage, these are not appropriate for any specific individual, and indeed would just say that as a fund manager, these are some of the currencies I see as having sort of like the most attractive risk-reward profile going forward. I think from a long-term basis, I think the Indian rupee looks to be something that will likely perform quite well. One of the reasons, or several reasons why I like the rupee quite a bit. One is the fact that right now it's actually the fastest growing economy of any major size in the world right now. It's eclipsed China. It's got a much more favorable demographic than China does. It has an English-speaking population, and they've been integrating themselves into particularly global outsourcing of services quite effectively. You have a government which, granted, is facing elections in May, and they're facing elections at a point in time where the Modi government is polling at fairly low levels. But it seems like most people looking at Indian politics think that at least it's likely that Modi will be reelected. And while that is somewhat troublesome in light of the fact that he has pursued a fairly radical Hindu nationalist policy, from a social policy standpoint, economically, the Modi government has been very pro-business and has done a lot to, I think, further integrate the Indian economy in a constructive manner, such that I think it's laying the groundwork for a nice long-term appreciation for the rupee. So that's one of the currencies we find to be most attractive. As far as most overvalued, I probably would say it's the pound, quite frankly. And again, I think there's just been some deep fragilities with regards to their financial system that, quite frankly, has never been sort of fully unwound from the 08-09 crisis. And the fact that right now there's been a lot of positive sentiment based upon the idea that there will be this soft Brexit or possibly no Brexit at all. But I think that, again, glosses over some of the deeper structural issues with the economy in Great Britain.
Well, great. You do some great writings throughout the course of the year, beyond just currency topics, but actually just overall worldwide economy and financial markets. Is it? I should have asked you before. Is that publicly available? And I guess regardless, where can people find out more about you and Whitmore Capital?
Well, I appreciate your kind words, and I do try quite a bit to sort of think very globally, and also trying to kind of zoom out from just the world of currencies and try to raise issues that I hope that thoughtful investors will find interesting and relevant to their own portfolios, regardless of whether or not they have any interest in currencies at all. And at our website, WhitmoreCapitalManagement.com, all of the writing that I have done is available there to be, there's links to all of that you can print out and read. And obviously I'm anxious for any feedback that people might have, and happy to answer any questions that any of the things that I've written will have raised too.
Well, Mark, thanks for joining us today.
Hey, Chris, a real pleasure, and thanks for having me.